Alibaba, Home Depot just reported Alibaba is down big because they missed big, but there's more to the numbers than just the big miss. Home Depot, about even though they beat on EPS and missed on revenue. So, guys, first off, if you're new to this channel, this is our Everything Money 24/7 channel. We do 4 or 5 videos per week dedicated to immediate market reaction, either on economy, earnings results like this, or any other news in the market. So if that interests you, do me a favor, subscribe to the channel, make sure you check it out because we do a lot of these reactions every single week. Now, for Alibaba, EPS of $1.40, missed at $1.42, revenue of $30.7 billion, beating at $30.4. But there's some confusion here as to what happened. If you look over here at the highlights in the quarter, so diluted earnings per share was 18 cents, a drop of 82% or something crazy like that. But the reason for that was a markdown of their investments in publicly traded companies. Now, we've talked about this before with Berkshire Hathaway. Warren Buffett and Charlie Munger think this is a terrible rule. But the new rule in the accounting world, based on GAAP, is if you own a stock and it falls, you've got to report that as a loss, even if you haven't sold the stock. If it goes up, you got to report it as a gain, even though it hasn't actually been sold. Last year, same quarter, Alibaba reported better results because of that same thing, because their investments went up. When you take out some of these things in non-GAAP, that's where the $1.40 came in, which was still a decrease of 5% year over year. So it still was a decrease, but it wasn't the 80-some% that we saw if you include the equity investments. So there's a little silver lining there. Here's a couple other attributes I'm not a huge fan of. Net cash provided by operating activities, it was a decrease of 26% compared to the same quarter last year. Free cash flow was a decrease of 52%. Now, they explain right here, though, that mainly reflected the increase in capital expenditures during the quarter, the majority of which reflected our investments in Alibaba cloud infrastructure. As you remember, a company like Amazon, for a long time, was just spending a lot on capital expenditures to grow their infrastructure. That's what Alibaba is claiming right here. The question you have to ask yourself is this correct, or are they trying to put lipstick on a pig? Not only was this the quarter end, it was also the fiscal year end. Revenue, an increase of 8% year over year for the entire fiscal year, $130.35 billion. This is what's funny to me, because people see the stock go like this. Everybody says it's a dying business. Is 8% growth amazing? No, but it's growing, and it's not a dying business. That's what's impressive to me. Income from operations was an increase of 13% year over year. So before, we sat there and saw, okay, maybe it wasn't that great. The quarter to quarter, it was down. For the year, still up 13%, which is a great sign and something good for any sort of investor in Alibaba. Diluted earnings per share for the year, both non-GAAP and GAAP, were up 14% year over year. So that's a plus. Again, 14%, pretty solid. And net cash provided by operating activities, though, was down 9% year over year. Okay, not great. But they did sit there and say the year-over-year decrease mainly reflected special dividends from Ant Group in the fiscal 2023. Again, it's still a decrease, but remember, this company is growing. They're still trying to sit there and become a bigger player. And there's some data I want to show you on that. Now, granted, this data ends at the end of 2022, but it's still interesting to look at their growth. This is a number of active consumers across Alibaba's online shopping properties from the first quarter of 2017 to first quarter of 2022 in China. 454 million, 903 million. In a matter of 5 years, guys, it doubled. 5 years. That's pretty solid. Now, China is the fastest growing middle class. Yes, they have a decrease in the population right now, and they're expected to go down to 1 billion up in like 50 or 60 years. 1 billion people from 1.6 billion, but they're still a fast growing economy. The average person in China makes 1/5 or 1/6 what we do in the US. So they're going to be a growing piece of the world economy. That's okay for the US. We should be fine with that. As we get larger and larger and richer, it's harder to grow that high number at a faster clip. The poorer countries are going to grow at a much faster clip. India is going to grow faster than China. China is going to grow faster than the US. Africa is likely to go faster than, parts of Africa will grow faster than India. This is the way the world works. The point is, as everybody else gets richer, we will get richer, China will get richer, India, all the way down the line. That's the way it's always happened, and that's the way it'll continue to be. Now, this is e-commerce market share of leading retailers worldwide. Alibaba is 23% versus Amazon at 12%. Now, Alibaba just announced a dividend. Guys, if you're new to our channel, I think dividends are the last thing that should be done with the cash flow from a company. They're trying to grow. They're trying to invest in themselves. They're trying to buy back shares. Why pay a dividend? People love dividends. They announced a permanent $1 per share dividend. In addition to that, a 66 cents per share special dividend. So for this year, it'll be $1.66 on their $80 price. It's about 2% dividend for the company. Now, here's a breakdown of the revenue for the quarter and the growth levels. You got a couple of small declines here, but the rest of them are all pretty solid growth. 5%, 3%, 20, 56, 11, 30, 19. Pretty solid growth. Obviously, some of the big numbers are from the smaller divisions. Well, except for this one right here. That's a pretty big number right there. But overall, 7% revenue growth. Guys, growing business. They're reinvesting back in themselves. The question you have to ask yourself is this a reasonable price for the company? Here is my thesis on Baba. And remember, I own Baba, but don't ever buy a company because somebody on the internet has it. I'm here to teach a process. And my process is to sit there and say, where are price and value disconnected? Price is what you pay, value is what you get. I want it where price is much below value, okay? Now, for any company I look at, I ask 3 questions. The first is, do I think this company will be around for the foreseeable future, 10, 20, 30 years and beyond? If the answer is yes, which I think Alibaba is a yes to that, my next question is, do I think that company will have more revenue and profit 10, 20, 30 years from now than today? If the answer to that is yes, my third question is, can I pay a reasonable price today that factors in that future growth or future decline, whatever it may be, that gives me an adequate return on my money? That's the question that's the most important. Because usually people hear growing business, it's exciting, blah, blah, let me go buy it. Well, guys, it's possible to overpay for a good thing. And Alibaba for the longest time was at $300 and some a share, and it felt like it was going to crush. And then China stocks tanked, and Alibaba tanked with it. Okay, that's fine. Charlie Munger says it was his biggest mistake of his investing career because he thought it was more of a tech play. But he still didn't sell out of his full position. He sold out half of it for a tax loss harvest. A guy we respect a lot, Guy Spear, he bought. We've bought. I'm down on my Baba position. Okay, I'm fine with that. I believe in the long term of this company, and nothing has changed my belief in that, even based on these numbers. And remember, quarter-to-quarter numbers, they're quarter-to-quarter. If you're a long-term investor, you should be looking at what happened here that makes me go, my thesis was totally incorrect. I have not seen that in this quarterly report or annual report. Doesn't mean it's not there, but I still see a growing business that is reinvesting back in itself in a growing economy. So I look at that saying, okay, this is the leader in that growing economy. This company will do well as the economy does better. Home Depot, they announced $3.63 per share in GAAP EPS versus beating $3.59. Revenue, though, missed $36.4 billion, missing $36.7 billion. Now, guys, here's their press release. The world's largest home improvement retailer reported $36.4 billion for the first quarter, a decrease of 2.3% from last year's first quarter. Comparable sales for the first quarter, the comparable sales decreased 2.8%, and comparable sales in the U.S. decreased 3.2%. What that means is comparable store sales. Stores that have typically been open 12 or more months, a decrease. And for retail, this is an important attribute, but it's Home Depot, guys. So this makes me ask the question, is the consumer not as strong as we think? I'm not saying that's for sure or not, but I look at this, I see Target's numbers being a decrease in comparable sales and going, these are very mature businesses that appeal to a lot of people. I wonder if the consumer, this is signs of the crack in the consumer. I don't know exactly, but I look at this saying, okay, decrease in same-store sales. We'll see how that plays out. But again, I ask the question, do I think Home Depot will be around for the foreseeable future? Will they make more or less money in that 10, 20, 30-year period than they are today? And can I pay a reasonable price? That's the thing, guys. What kind of world would we live in if Home Depot was gone 10, 20 years from now? I'd be like, man, what happened? I'm not saying it can't happen. Anything can happen. But what has happened in this world if Home Depot was gone 10 or 20 years from now? That's the interesting part. So their 2024 guidance, they have reaffirmed. Total sales growth of 1%, comparable sales to decline approximately 1%, 12 new stores, gross margin of 34%. That's pretty solid, guys. Operating margin of 14%. So I'm looking at this saying, okay, they are It's a slow grow, 1% overall sales growth, 1% decline in same-store sales, 12 new stores, not some big growth numbers there. But Home Depot is a large organization with lots of stores internationally in the US, etc. It's going to be hard for them to grow like they have before. Why? Because they're so mature already. You cannot expect this company to be growing big time. The way you're going to make your money on Home Depot is them buying back cheap shares if the stock falls precipitously. And for those of you who like dividends, at some point, if they're an expensive company that can't buy back useful shares, they're going to be paying out a dividend. That's how you're going to make money on Home Depot, buying it at a cheap price. But the thing is this, guys, I don't want them paying that big dividend. What is their dividend right now? Let's pull it up right now to see where it's at. Their dividend is currently 2.5%, eats up $8.5 billion of their 5-year average free cash flow of $14 billion and their 1-year free cash flow of $18 billion. So they can afford that dividend, but as this stock gets cheaper and cheaper, its all-time high is $420 back in December of 2021, and it's currently at $339. But it hit a low of, how low did it get here? 265, 265. Yeah. So 265, 270. At that price, the PE is sub 20. The price of free cash flow is sub 20. Well, it's currently sub 20 on the price of free cash flow right now of 19. So at 250, 265, they were at 12, 13 times free cash flow. Buy back those shares. Stop that dividend. Buy back a crap ton of those shares. Save your $8.5 billion a year. And at that point, it was $250 billion market cap. You could have been buying back 3% of your shares every year. That's how you drive value on cheap companies. So this is the 3 months ended April 30th, 23 to 23 to 24. Pretty much every category you want to see is going in the wrong direction. Sales all down, expenses up, operating income down 8.5%, interest income up 72%, net earnings down 7%, shares outstanding down 2.1%. So they bought back shares, expensive shares. Thanks, assholes. Basic earnings per share down 5%. Guys, I look at this saying, I just have a beef with companies. I mean, could you make the argument that 18 times free cash flow is a reasonable price to buy back shares? Maybe, but I don't really like that. I want them buying super cheap shares. That's what's so great about stocks falling. If a stock falls a lot, you can do a great job by sitting there and buying back those shares. Now, guys, customer transactions down 1%. Average ticket down 1.3%. Sales per retail square foot down 3.4%. I don't know. This one seems interesting to me. Now, if you're part of our community and you have Home Depot stock, I really encourage you, go into the chat and start talking to people about it, because this data is not good, but is it a cyclical situation? But this can be an emotional roller coaster for you. What I'm surprised about is it's only down 0.5% right now. How is it down only 0.5%? This is way worse than Alibaba's data. This is what I mean about the emotion of the market, the euphoria. We have no idea what's going to happen. No idea. I'm surprised Alibaba is down 7.5% right now and Home Depot's flat. These results were not good results. But you sit here and look at it and going, okay, this is what the market does. The market overreacts. The thing I want you to focus on is you not overreacting. Everybody has the brain power, as Peter Lynch says, to buy stocks. But who has the stomach to buy stocks? Who has the emotional capability to sit there and say, this data is not good. I own the stock. Is it still a good stock to own right now based on what I foresee for the future? The longer your time horizon, the better you're likely to do. But in that time horizon, the stock may go like this, but it's probably the value is going to go in a straight line, but the price is going to fluctuate like this. It's awesome when this is here, but not when this is here. That's what's hard. We've all been there. Just this morning, I was thinking about my mistakes in the last 5-6 years on investing, just going, my stomach. It was like, it was really churning at me. I'm no different than you guys. It always happens. But then when I sit there and say, I've been through it enough to sit there and say, okay, well, what is this telling me? What are the lessons I'm learning here? Well, when I look at good companies, I think about the long term. Whenever I get worried about a company in a short run, I immediately go, okay, what's the long run of this? Is this company going to be around in 10 or 20 years? And for me, if my answer is I wouldn't be surprised if they were gone, I don't want to own the company. I believe the adage that Warren Buffett says, if you're not willing to own a company for 10 years, don't own it for 10 minutes. And also, you should only buy a company if you're okay with the market shutting down for 10 years and you couldn't sell it. And I look at my portfolio going, I feel that way about my companies. And that makes me feel good. I do not own Home Depot yet, but at some point I will own Home Depot, hopefully, if it gets beaten down. That's what I'm hoping for. That's the emotional part of investing that I want you to become much better at, because you will do way better in investing when you're able to root on lower prices. When you're able to sit there and say, God, I hope Home Depot goes below 200 or whatever the number ends up being. So if that makes sense to you and you want to be better with the emotional side of investing, join the community of thousands of like-minded investors who can help you every single day get better at the emotional side and therefore probably better with your results. Click the link below. It's only $7 for 7 days. Get a grip on your emotional side of investing and use the tools in the software as the extra added bonus to understand the fundamentals. Thank you very much for your time, and don't forget to subscribe to this channel.